Was Thursday's sell-off an overreaction? In hindsight, I think it's fair to say that the intraday move was overblown, but we do need to at least acknowledge that there were some substantial shifts that actually damaged the market's structure. So let's explore these shifts by looking at all of the data points and building a game plan based on logic for the coming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe for 100K by May, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame chart, let's first talk about candle structure and location as we always do. In terms of structure last week, a red hammer-esque style bar printed out. So let's firstly acknowledge that, yeah, of course there was some sell-side pressure applied against the market, but the long lower wick would also imply that there was some response from our buyers, and they were able to close more so towards the midpoint of the weekly range, instead of allowing a weaker close towards the lows or just generally in the lower third. So structurally, I would say we have a neutral bar. It's not bullish. We've certainly closed underneath the opening print, giving us the red body in the first place, and there was no breakout up and over the previous 2-bar highs, which, as we know, was a bullish 3-bar play. So it's a great segue into location on the bar-to-bar count. We've just produced an equal high as well as a lower low on the bar-to-bar count, but we're still very much so contained within the first bar that sets up the 3-bar play in the first place. So starting to build out a more neutral weekly balance range here, and the overwhelming trend is still certainly up. Let's not lose sight of that, right? We have October lows, major higher low, minor higher low in the balance range, minor higher low in the balance range. This very well could be the next higher low, a very minor one inside of a balance range, especially if we can get a break to a new higher high in the coming week's worth of trade. So on the weekly time frame chart, no damage was done structurally. As we get down to the daily charts, hourly charts, and supporting evidence charts, that's where the damage starts to show up. So as we walk forward here, I'd still use this as a line in the sand on the weekly time frame. That level is 502.503. It represents the top of the 2-week balance range over here. And if we bring out our Fibonacci's from the January pullback low up to the all-time high, it's still very much so confluence with the 38.2. So structurally makes sense, Fibonacci-wise makes sense, and over time, it's not going to be perfect, but over time, let's bring out those anchored view apps. Maybe 1, 2, 3 weeks into the future, we might also get confluence with the anchored view app, and generally speaking, because we're above the entire spread of anchored view apps, I would have to look at this as still bullish consolidation in the grand scheme of things. And a great piece of supporting evidence for bullish consolidation is actually the volume profile here on the weekly time frame chart. Now, this is very nuanced and it might be dim on your screen. However, there is a high volume node right here, which represents the bottom of last week's bar. And that shouldn't really come as much of a surprise. We'll see this on the volume profile when we get on over to market profile for the ES. A ton of volume went through at the Thursday low. And you can see that we've resolved that via the lower wick by closing above the high volume node. So I would be more so inclined to think of this as a multi-week balance that's potentially building out right now. If we break down underneath the high volume node, maybe we'll change our tone on the daily chart for a deeper pullback to the weekly higher low zone at 503, top of the NVDA earnings gap. So underneath 512.50, 512.75, that's this high volume node once again, 512.50, 512.75. If we break down underneath, the weekly target would be 503, 502. If we consolidate within, this is nothing more than healthy bull flag consolidation, basically at the all-time highs on a higher time frame chart. So if we ask ourselves, was Thursday's sell-off an overreaction? If you're a weekly swing trader, if you're someone using weekly charts for analysis, this is just noise. This should absolutely not impact your trade plan in terms of the weekly trend. On the daily time frame chart, let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 527.32, and that would imply a higher high and a new all-time high. If we're contained by the lower bound, the number's at 509.59, implying a lower low. And the issue with the expected move this week is that it doesn't really show us any sort of edge, bullish or bearish. The only thing that it shows us is that volatility has certainly expanded. So let's talk about the daily trend. If we count trend from here, we had lows, higher lows, higher lows, higher lows. We gave this as a higher low, and we even said, buyers, you know what, we'll give you the benefit of the doubt, holding up here over 517.25. Previous top end of this as a balance range has the opportunity to act as support. And you can clearly see that on the Thursday breakdown, we of course offered a more severe lower low. So this is structural damage point number one. Lower low on the daily trend. Now the issue is it's not clear because we have highs, and equal highs, and these are all all-time highs. So are we in a daily downtrend? I think it's premature to call this a daily downtrend. The other piece of sort of confusing information is that we've technically closed back above that key level at 517.25. So on the daily time frame chart, I really think that you want to simplify things headed into this week, right? If we're over 517.25 on the daily time frame chart, that of course implies that we're in the upper portion of the weekly balance range that we were just referring to. We also know that the all-time high should certainly not be set with 3 equal highs back to back to back. This is the improper end of the auction. So if we're getting consolidation, if we're getting price acceptance over 517.25 early on in the week, I would be thinking about what's the opportunity to test and possibly break out up and over 523. Again, we're going to keep it very simple on the daily time frame chart. We'll get more nuanced on the hourly. To the downside, if we slip underneath 517.25, that would start to represent that we're consolidating in the lower half of the weekly balance range, right? And as we talked about, a breakdown underneath 512, 512.50, 512.75, basically Thursday's low, a breakdown underneath that level probably opens the door for lower. And the weekly target is 503 in the top of the NVIDIA earnings gap, which is this yellow zone down below. But what stands in our way? It's these 3 equal lows. Just like we talked about, this is the improper end of the auction at the highs. This is still a structurally weak area on the chart. That level is 509 on the S&P cash market, right? So 509, if retested, coming from price acceptance underneath 517.25, is a threat to the downside. When and if tested, I would be expecting a break. Now, if the 50 SMA is going to meet us there for confluence, maybe this happens later on in the week, Thursday or Friday, we'll take that as maybe a supporting piece of evidence that we'll try to look for buyers to show up there. But there's really a deficient structure based on this previous interaction, these 3 previous interactions at 509, and I want you to be very aware of that. If we break down underneath 503, the weekly target could be in play. And remember, this is the NVIDIA earnings gap. What do we know about the tech market as of right now? It's basically sitting right on top of the NVIDIA earnings gap. So putting all of the pieces of the puzzle together on the SPY daily, use 517.25 as your judge. If we're over, the weekly chart is looking constructive for higher. If we're underneath, it certainly sets up an opportunity for a little bit of a reversal, right? If we're spending time under 517.25, let's just talk about pattern for a second. We get something that looks like this. Here is your Man Ray, and there is your lower high, right? Build out a right shoulder underneath 517.25, and I would more definitively change my tone. As of right now, early on in the week with the back and forth, so lower low, but then close over 517.25, I think we want to be a little bit more neutral instead of outright bullish or outright bearish. This one's really going to require a little bit of patience early on in this coming week's worth of trade. The last thing I'll leave you with here before we drop down to the hourly is multiple trend channels on the daily, right? If we zoom into this, the major trend channel, this one, which is fairly steep, mind you, has certainly broken down. That came from the Tuesday gap down. Thursday's gap up open was definitely not ideal as a backtest lower high or equal high up against the bottom support portion of the trend channel. But if you bring out a minor trend channel coming from the NVIDIA earnings gap up low and start to connect some of your lows, that's exactly where we found support on the Thursday session. So once again, going back to the question from the intro, is this an overblown sell-side reaction? Based on the daily time frame chart closing back over 517.25, I would keep an open mind to this on the higher time frame charts. The supporting evidence is really where we start to see, okay, probably dial some of that back, so make sure you stay tuned for that. Let's go down to the hourly though. So here we can see that perhaps similarly to the daily time frame chart, the trend is not so clear. We've got the offering of a potential lower high, but we've also got the offering of a potential higher low. And the most interesting part about the potential higher low is that it's technically over the daily line in the sand at 517.25. So who's ultimately in control of the hourly time frame chart? I don't think that we have a clear answer. If the sellers were truly going to get the picture-perfect setup into the end of last week after the Thursday momentum breakdown, we should have been looking for a lower high underneath 517.25, and that was part of the plan during the emergency meeting on Thursday's episode, right? So with this higher low above, I think we want to keep an open mind as we've already described on the daily time frame chart, but to further illustrate the push and pull, let's use a couple of Fibonacci's coming in from the Thursday high of day to the Thursday low of day. You'll notice that the sellers were able to reject the 61.8, and as we know, if we can breach the 61.8, the odds of a 100% retracement dramatically increase. So that strikes me as a small win for the bears. If we look at where the 38.2 is, though, its direct confluence with 517.25, that's exactly what offered support into the end of day on Friday. So again, who has the upper hand here on the hourly chart even? It's not so clear, right? The sellers, in my view, technically have failed a little bit more so than the buyers. This breakdown really should have yielded some sort of lower high if there was going to be follow through in the downward direction underneath 517.25. One more Fibonacci perspective is coming in from the Friday low to the Friday high, and what you'll notice is that we technically closed over the 38.2, so that's a step in the right direction, and there was no breakdown at all intraday underneath the 61.8, suggesting that a rotation back down towards Thursday's low was a higher probability outcome. So really trying to illustrate here and make it very, very clear that I don't think it's straightforward early on into the coming week's worth of trade. I will give you a couple of situations that I'll be mindful of. Of course, staying over 517.25, as we talked about on the daily, strikes me as being more bullish than bearish because of the weekly tailwinds that are behind us, pushing price in the upward direction. If that's the case, I would start to consider this a little bit of a look below and fail. This higher low holding opens the door for moves back into 521 and 523. At that point, you're basically at the all-time high and looking for follow through in the upward direction. So how does that unfold? Continued holds of this 517 could turn this into some sort of double bottom. You could sweep it again, so something that does this, sweep, and then higher low above, turns this into an inverted head and shoulders. Anything that holds over 517.25 with an actionable intraday setup, I'm interested in longs back up towards 521. If we slip underneath 517.25, this is where I would start to consider that this could be a lower high on the daily time frame chart, and we really have thin structure over here. I believe it wouldn't be unreasonable to test the lows of Thursday, if not 512, sooner rather than later. But again, that requires no ifs, ands, or maybes about it. It requires a lower high underneath 517.25 so we can manage our risk. So that's what I'm thinking about to the downside. One other interesting perspective here, and we'll see this on the volume profile from the market profile, is that if we're staying over 517.25, I believe that the sellers from the Thursday breakdown are massively offsides, and there is an opportunity to continue to squeeze price in the upward direction. What would really put the icing on the cake here would be a gamma squeeze. So watch out for the call buying volume early on in the week in the S&Ps. If you're not familiar with this, go on over to the trade tab here in Thinkorswim, open up your options chain, or minimize, I should say, and then open up today's option statistics. So this is going to be reading for Friday, of course, but look at the call sizzle index on Monday. If the call sizzle index is over 2.5, that would be indicative of the opportunity for a gamma squeeze in the upward direction based on the mechanic of call buying, right? Meaning that the market makers sell you the call. Technically, they're then short the market. They go out and they buy ES futures. They buy 100 lots at a time in the spiders to sort of make up for that and become delta neutral. That would lead to a gamma squeeze. So watching out for that dynamic if we can hold over 517.25 and continue to squeeze out some of the shorts here. The gamma squeeze would be the icing on the cake. Let's bring out the intraday anchored view apps and we'll see what's going on from this point of view. You'll notice that we're tangled up in no man's land here, so I really believe that neutrality is your first bet early on in the week. If we're offering an actionable bullish setup over 517.25, it's probably worth taking a stab considering the weekly trend. If we drift underneath 517.25 with a lower high, it's game on once again for the sellers to really try and prove it and produce continuation in the downward direction. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The market internals really help us remember that there was a change in tone on Thursday in all of our major market internals, and as we noted, a substantial flip in the index score into the close as the sell-off was really accelerating. So when we look at this screen, I think it helps us dial back some of the more bullish tone we maybe had on the hourly chart, exploring that close over the 517.25 mark. I think it's worth being very open-minded to in early morning, like on Monday morning. I would not be surprised at all. This should not shock anybody. If we break down on an opening drive underneath, in the futures it would be 52.50, in the S&P cash it would be 517.25, lower high underneath. Like, that should not surprise anybody given what happened internally at the exchange level on the Thursday breakdown. So although maybe we had a bit more of a bullish tone on the hourly chart on the look below and fail, the opportunity to ride the weekly tailwind in the upward direction, this dials that back just a little bit, acknowledging that, yeah, there was a change in tone on Thursday. And if we look at how it was followed up on Friday, it's not like we saw substantial volume inflows. You can see that here. We did not reach 300 million positive. The advanced decline line never got into trend higher zone, and it actually faded into the afternoon. And you can see the same thing out of the cumulative tick down below. Typically, a read that does this and then fades is more indicative of a squeeze, not necessarily stronger buying pressure. So could this have been a counter trend move in the context of a tone change? I think that's absolutely a reasonable opportunity here, but once again, let the price levels really determine whether or not you want to action on bullish or bearish trades. In the ES 5250, in the SPY Cash ETF 517.25. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And just like everything else, there are two big perspectives that are conflicting here from the market profile. The first one that I'll show you is that the Tuesday low is where we get the value area low on the Friday session. If stronger sellers were truly emerging in this market, value area would have been left underneath this zone down here, pulling prices back down towards that early on in the coming week's worth of trades. Simply, it did not take place. So value shifting over Tuesday's low strikes me as a bullish takeaway. Now, what's the bearish takeaway? In theory, these are a string of single prints through J, I, and K periods, and what you'll notice is that we did not rotate all the way towards the closure of those single prints loosely around 52.95. So if we had stronger buyers, should we have made it all the way there? Let's firstly acknowledge that obviously the range has expanded massively, and Friday we were certainly outside of the average true range of what the market has typically been producing. So I think the big test early on in the coming week's worth of trade is just to identify what happens at the test of the poor high from Friday, because we do have a poor high. G and H are back-to-back flat, right? So here's the takeaway. If we test Friday's high, I would be expecting a break. And in theory, if the buyers are going to do their job, they'll rotate through the thin structure and we'll get a move into 52.95 roughly, something that looks like this. If instead the bears actually show up and we produce a break of the poor high but rotate back into the Friday range with a lower high, that's a pretty big tell that the buyers did not do their job of closing this thin structure, and it's a bearish takeaway. We'll look for a move in the downward direction. So that's the market profile. The first thing that I would lean on into the coming week's worth of trade is simply the idea that the value area on Friday is above the Tuesday low, and that strikes me as being a slightly more bullish than bearish takeaway. Changing gears to the QQQs on a weekly time frame chart, what do we see here in terms of candle structure and location? Very similar to the S&P 500, we've got ourselves a weekly hammer-esque style bar, maybe a little bit more of an upper wick on the QQQs, but regardless, we've closed more so towards the midpoint of the weekly range instead of weaker towards the bottom of the weekly range. In terms of location, bar-to-bar count is an equal high and a lower low, just like the S&Ps, and you can clearly see on the NASDAQ, we've been in a balance range for almost 6 weeks now at this point. So we've closed in the midpoint of that range. I'll say at one time and one time only. Do not diddle in the middle of any given range. Buyers have the edge when and if we can break the upper edge. Sellers have the edge when and if we can break the lower edge. So that brings us to our next point. What is the prevailing winds on the weekly time frame chart? Certainly uptrend here with lows, consecutive higher lows, and this balance, as long as the lows are holding here, are building out higher lows in the trend trend count. We're hovering near all of these equal highs, which are all-time highs, so I'd be very hard-pressed to say that the QQQs on the weekly are bearish just yet. Again, if you're looking for a larger breakdown, wait for the range to break. All of this then acts as overhead supply. The idea would then be to find a lower high underneath 433 and then continue in the downward direction if you're trying to look for a larger reversal. As of right now, it seems like there are lower odds of that, considering the lower wick finding support directly off the bottom of this weekly support. Let's bring out some Fibonacci's from the bottom of the January move up to the all-time high. All of this is taking place over 38.2, technically classifying it as bull flag consolidation. Again, hard pressed to be bearish on the higher time frames right now. Let's bring out the anchored view apps on the QQQ weekly, slowly getting better confluence. Again, maybe over the next 1, 2, 3, maybe even 4 weeks, this will provide confluence at the bottom end of the range, and then it will become an even more key level. If it breaks, you're not only breaking the bottom of the range, you're also breaking an anchored view app, and you would expect the rotation in the downward direction. The line in the sand on the weekly time frame chart really has not changed. It's around that 410 to 412 zone and previous confluence with the previous all-time high, I should say. Let's take a look at the volume profile on the weekly time frame chart. We do not get that interesting volume blip like in the S&Ps. However, the highest volume node of these new money all-time highs is at the bottom of the weekly range. So once again, if we're above that level, it has to strike me as bull flag consolidation until proven otherwise. If we slip it with a lower high underneath, we will change our tone, but the lower wick on last week's bar would tend to have me feeling like we want to be neutral to bullish on the higher time frames. On the daily time frame chart, as always, we will begin with the weekly expected move, and if we're contained by the upper bound, the number is at 449.83, implying a higher high over the Thursday gap up open, but an equal high to the all-time high in the QQQ. If we're contained by the lower bound, the number is at 431.10, implying a lower low, but most importantly, it's a suggestion that we could break down into the NVIDIA earnings gap as soon as this week, right? That number is underneath 433.75, closes down at 420. 25.75. In terms of the daily trend, it's simply non-existent, and this should not come as a surprise considering what we just covered on the weekly time frame chart. But one of the big differences here out of the QQQ NASDAQ is simply that we did not close above the judge of price action, 441.50 on the QQQ, unlike the S&P 500, right? Closing over that 517.25. And I would even make the argument that the stronger line in the sand on the QQQ daily should be a little bit higher at 443.50. The reason being is that this was a micro balance inside of the overall balance, and we're rejecting that in the upper wick of the Friday session. If stronger buyers are truly going to emerge, we do not want to see this act as overhead supply. We want to see the buyers break into that range, get consolidation up here, and then maybe there's the threat of a new all-time high. Obviously, given the close on Friday, leaves a little bit to be desired here, and I would argue that the bears have a bit more of a sell-side edge on the NASDAQ compared to the S&P 500. Let's move on down to the hourly time frame chart and evaluate what's happening here in terms of trend. The trend is a little bit more firmly down on the QQQ hourly time frame chart, right? You've certainly got highs, lower highs, equal high, offering of a potential lower high. You have low, lower low. I think that the lower high is stronger, especially noting what's happening into the Friday last 2 hourly bars, right? Look at those last 2 bars. Both upper wicks are rejecting the key daily level, which I know we gave some leeway up towards 443.50, the bottom end of the overhead range back here, but look at the upper wicks rejecting 441.50. If stronger buyers were going to emerge, we would have expected maybe some price activity above that or an attempt to close above that. Simply didn't take place. Even in the topmost portion of that upper wick, it's underneath 441.50. It's not like the upper wick extends beyond that level for an attempt to get consolidation up here. So for that reason, I would give the bears a little bit more of an edge if we come in with the Fibonacci's just to be congruent to the S&Ps. For the Thursday session range, we're still rejecting the 61.8, but holding up over the 38.2. So maybe neutral through no man's land with a daily bearish edge underneath 441.50. If we come in from the Friday low up to the Friday high, we are still technically closed right on the 38.2. So I'm not sure it's fair to say that, at least in relation relationship to the Friday retracement in the upward direction, we have bears really coming out of the woodwork and hammering this thing back down underneath the 61.8. Let's remove that and bring out the intraday anchored view apps, and then I'll give you some pathing here on the QQQ. What you can see is that we're still underneath 1, 2, 3 of the 4 anchored view apps, and the primary ideas that I would set forth for the coming week's worth of trade is that consolidation below 441.50 that puts in some sort of range and then breaks down. We're really looking at the equal low to Thursday's low. I wouldn't get too hung up on the 438.50. It's a possible contender, but Thursday's low would be the stronger target, and then it's just the NVIDIA earnings gap, right? So that's one situation. You could obviously open underneath, set a lower high underneath. All of that is valid. If we get an open that sort of pushes into here, I would be very neutral through this range for all the reasons we just talked about on the daily, right? This, as overhead supply, can still act as resistance at 443.50. So if we're getting this kind of rejection in here or just struggling, I would then look to execute on a bearish trade. Lower high under 441.50 is the nail in the coffin. Trend is firmly in the downward direction. Lower high here, stop goes just above, retargeting. Again, probably looking at Thursday's low as the major target. A little bit of a hiccup here at 438.50 is an opportunity. If the buyers are really going to step up and make something happen, clear that level. Show me the higher low over 443.50, and then we'll be back off to the races. I think that if you can clear the upper bound of the anchored view apps, which as we just saw from a Fibonacci perspective is also the 61.8, if you can get above that, I'd be willing to say, okay, let's change our tone. We're just flip-flopping back and forth in this neutral daily balance range, but if we're over 443.50, we'll be open-minded to an attempt in the upward direction. One thing that this would indicate is a full-blown retracement of the breakdown from Thursday is a total failure from our bears, especially noting in the NASDAQ that we had preceding weakness before that breakdown from the Thursday momentum. One of the things that you could also be mindful of as a long is if we look into the NVIDIA earnings gap and do not flush through it. So let me just remove those intraday anchored view apps. They get a little bit distracting here. But if we do something that looks like this, so let's say that the bearish setup plays early in the week and we get down to here. Let's say we give one of these. If something like this happens later in the week, we're talking about Thursday, Friday, and we'll of course update you on Wednesday for the midweek market update. But if we get a look into the earnings gap below, which we know there's zero structure down there, and then get a higher low back above 433.75, that's just a textbook reason to play the bottom end of the range with extremely tight risk reward, right? You're playing ping pong, look below and fail, retargets in theory, probably like a weekly chart, the top of the balance range, tight risk reward, entries, stops, and looking for upside, right? There's no guarantee that it has to play out, but it's a trade that I would at least consider if there is no acceleration through the NVIDIA earnings gap. Let's take a look at the market internals for the NASDAQ side of things, and you can see that, of course, there's your change in tone, not so much actually out of the cumulative tick. I mean, the cumulative wasn't so bad, but if you actually look at the tick activity, it was very similar to the S&P slamming underneath negative 1,000. So again, I would still argue that that was a change in tone. Another thing here is that the Tuesday breakdown was a little bit more substantial in terms of the bear side sell-off compared to, on a relative basis, the S&P 500. Volume flows were substantial here, and we were underneath trend lower zone on Tuesday. Cumulative build is substantial as well on Tuesday out of the NASDAQ versus the S&P, which was a little bit more mild. It was certainly down, but it was definitely way more mild in the S&P 500. Final notes over here on the NASDAQ market profile, incredibly similar to the S&P ES. So what you would be doing is just checking in on your Tuesday low. Where is the value area? It's certainly above. That strikes me as an initial failure from the sellers, right? And then in terms of upside, what do we have for single prints overhead? You'd be looking at 18,480. 18,480. Poor high is in force, so all the same setups apply. If we can test it, I would expect a break and a closure of the singles. If we test, break, and then stuff back into range without closing those singles, that does strike me as a bearish setup, probably as actionable on any lower highs back down inside of the Friday range. And lastly, for the broad market ETFs, we have IWM Russell 2000 and the small caps on a weekly time frame chart. What do we see in terms of candle structure and location? Certainly the structure is much different than what we have in the S&Ps and the NASDAQ. Solid red-bodied bar, very minimal lower wick. There is no indication of a close towards the midpoint of the weekly range. The sellers have much more of an upper hand here, closing in the lower third of the weekly range. In terms of location on the bar-to-bar count, we do see a lower high paired with a lower low. Bears go 2 for 2 on the IWM weekly time frame chart. What's the trend overall, though? Is this the end of the world? It's not the end of the world yet, but it is starting to become slightly concerning. We have lows, big time higher lows, micro higher lows, and if this reverses immediately, it could offer a higher low. We really cannot afford the IWM to get down underneath 200 as the nice round figure. Why 200, you may ask? Well, if you've been living under a rock, let's show you the light. Here we go. IWM on a weekly time frame chart has a huge balance range underneath us, a multi-year balance at this point that we've broken out of. If this is going to remain constructive as a tailwind for the S&P 500 and the broad market as a whole, we want to see small cap participation moving back up towards the all-time highs. If we are over 200, this stays in play as a breakout. If we fail underneath 200 or 199, as we'll see on the daily time frame chart, this is a failed breakout, and we have nothing more than a massive lower high set on the retest of the lows of the overhead balance range, right? So is this a reasonable place for the market to be pulling back from? I think the answer is yes, but the key point walking forward is that we need consecutive higher lows, and we need the small caps to continue to participate in the upward direction. One of the issues with this is the fundamental narrative that, hey, Neil Kashkari comes out and says, hey, maybe no rate cuts in 2024. Waller, no rush to cut rates, right? We had Goolsbee, like a number of Fed henchmen came out and were like, maybe we'll change our tone. Maybe we don't need cuts in 2024. Growth is fine. Labor market's fine, right? So that's going to act as a headwind for the IWM. And if that's not sort of enough, I don't want to call it evidence, but let's take a look at the XBI, biotechs, right? This is a very similar setup where basically this, as a balance range underneath us, started to break out. This has failed back down underneath. Let's hope that this is not sort of a harbinger for the small caps, right? So there's biotechs. Another one would be the XRT, retailers, right? What do retailers look like? There's certainly this attempt to retest and possibly break back down underneath. If that takes place, if there's a stronger loss of 73.25, I mean, I don't want to say the writing's on the wall for the Russell 2000 small caps, but man, this is really not looking great in terms of smaller companies, literally small caps, participating and getting continuation if we're going to see a little bit more of a hawkish Fed. So regardless of your stance on whether or not Jerome Powell is right or wrong, all you have to do is literally look at the market components that make up the index of what's most sensitive to financial conditions, aka small caps, right? So that is my take on the higher timeframes. Let's go back to the IWM here. I don't want to be doom and gloom, right? Because we still certainly have not broken down through 200 yet. I think that the test could be underway this coming week's worth of trade, and it's a matter of whether or not we find buyers there. So if we do, then awesome. That's a very constructive higher low. If we rotate away from it, great. It's a constructive higher low, but I do need you to at least be mindful of the importance of 200 and what that ultimately implies for the S&P 500. Let's take a look at some supporting evidence here. We'll move on over to our weekly anchored view apps out of the IWM. Still somewhat looking good. I mean, these are creeping in the upward direction. It's a huge band of support underneath us. Could you get a monthly higher low in this zone? The answer is yes. The unfortunate part, though, is that it would suggest a breakdown underneath 200. So we really don't want to see that this week. If we come in with some Fibonacci's, we'll just do a couple of fib takes. Coming in from the lows up to the most recent highs, the 38.2, again, still could offer technically bull flag consolidation, but underneath 200 gets a little bit dangerous for my taste. I would prefer to see this act as our firm area of support. And for that reason, we'll take one last look at a fib from here up to here. And what do we see? The 50% retracement is kind of right on the money at 200. Ideally, if this 38.2 is going to hold, show me the reversal and we'll let out a huge sigh of relief and say, okay, thank goodness small caps can continue to participate here. But if we break that, I would start to be a little bit more on edge. Once again, 200, I can't underscore the importance of that level enough here out of the IWM and small caps. Sorry, before we go to the daily time frame chart, I cannot leave out the volume profile considering it's a pretty compelling piece of evidence for the bull case and the highs of the balance range to hold. We have a huge high volume node at that location, 200. So does that stack up as a bullish data point, maybe suggesting that it can hold? It's something to at least carry forward and include in the analysis. On the daily time frame chart, let's check in on the weekly expected move. Upper bound is at 209.61, implying a move over the high of the Thursday breakdown, but a lower high from the most recent swing high. And the lower bound is at 199.26, implying a lower low and equal lows to this area here, basically at our weekly threat level of 200 and 199. So that to me is an issue. It is possible that we come in for that test. And one of the things on the daily time frame chart that becomes concerning concerning is that this can act as a higher high double top, breaking the neckline certainly changes the trend. A lower high underneath is dangerous. Let's not jump the gun. It's just one continuation of the weekly conversation we were just having. One of the things that I find compelling to the bull side, if we're going to play both sides of the argument here, is that we technically opened incredibly weak on a very small gap down on Friday compared to the opens inside of range on the spiders as well as the Qs. So the fact that the Russell did not just break down and fall off of a cliff on Friday is somewhat enlightening, right? It shows us that the sellers kind of ran out of bullets, so to speak, at these lows, and a counter trend move or consolidation in here as we resolve some of the tensions from the Fed could be very likely. If we're consolidating over 204, which is this key inflection point from back here, there is your daily head and shoulders. If we consolidate above that, I would be neutral. There's still an offering of that potential lower high count, but you're getting compression out of the range with higher lows as well. If you fall underneath last week's low and break down underneath 202.65, I think fate has it that we're testing the big weekly inflection point at 200 that we've just described. If we're totally going to be rainbows and butterflies, we're in the clear. You've got to break out over and even show me the higher low, not even just break out, but show me the higher low over 206.50 will change our tone for the continuation of the drift in the upward direction. It certainly has not been clean, right? If you're counting trend, it's lows, higher lows, higher lows, higher lows, and then this is where it runs out with the lower low and the offering of a lower high. So technically speaking, very nuanced daily downtrend here out of small caps. Here we go on the hourly time frame chart. What do we see in terms of pattern? Maybe a bottom of the barrel, head and shoulders, once again reinforcing the idea of the importance of 204 breaking down underneath gets a little bit dangerous. You can see the gap down open on the Friday session, then got consolidation above. So if this is going to be a look below and fail on these lows, the rotation up towards that 206.50 could be early on in the week, and then we would watch, can we get a higher low pullback? Can we get a break? Can we get a higher low above that, right? The sequence continues from there. But your inflection points are very straightforward based on all of the evidence that we have in front of us. For congruency, again, we'll take out the Fibonacci's from the Thursday high to the low of the Thursday session, which would have been here. Let's get a click. There we go. And the 61.8 has not been tested. So one of the risks out of this chart is that the head and shoulders, the bottom of the barrel head and shoulders that we just described, can still offer a lower high up against that 206.50s. If we, sort of rotate against it, bring you back down to the neckline, that's where things get sort of dangerous. So that is interesting to me. Notice that the 38.2 offered resistance on that Friday session. If we consolidate down here and never make it there in the first place, that is even more bearish in my opinion. Let's take a look at the intraday anchored VWAP, see if this is offering anything interesting underneath a bulk of them, certainly rejecting into that Friday afternoon, the 3 overhead. So I think that the bears have a little bit more of an intraday edge here with that lack of retracement into the highs or even the midpoint of that Thursday range. And we already saw the damage and the difference from the weekly time frame chart as well. Moving on over to the Russell internals, you can see stronger volume outflows, cumulative net flows out of the Russell on the week. Those numbers are just shy of 200 million. 200 million is the substantial mark, so not all the way there, but certainly damage on Tuesday, damage on Thursday. The advanced decliner is bearish Tuesday and Thursday as well. All the same takeaways. I would say that this mirrors more closely the NASDAQ compared to the S&P 500, with a bit more damage being done on that Tuesday session, setting up more of the bearish slant and tone in the first place, which totally aligns with the fundamental narrative of rates and sort of the dialing back of expectations of a cut. Here we go out of the market profile, and again, the main takeaway, although the structure is not identical to the Qs and the S&P, you'll notice that the value area on Friday was above the 3 equal lows, 1, 2, and 3. This was a mechanical low. It is now counted as repaired with the A period string of single prints underneath, and the value area above, once again, sort of counterbalances maybe some of the bearish talking points we just had on the hourly with the rejections of the Fibonacci's and possibly the lower highs. One of the interesting notes is that this, as a single print closure, is basically confluence if we go back on over to here. So single print closure is still technically a lower high. Daily chart, right? So highs, lower highs, lower highs if we reject off of that. I wouldn't be surprised to even see a lower high underneath that in the single print. So that would really just be your Wednesday high of day. If we flip back, you're looking at something over here. So 2105 out of your Russell futures, if you stuff underneath it, there is no poor high on Friday. So if you get a little bit of a rally, some lift, and stuff underneath 2105 in the RTY futures, that's your pretty big heads up that the bears probably have the upper hand here. Taking a look behind the curtain at the weekly performance of the S&P sectors, we can see that leading the pack here is energy, up 3.58% on the week, followed by communications 1.19%. If we want a third, it's all the way down at the bottom. The XLI industrials only down 0.33%. At the bottom end of the barrel, it's the XLRE, extremely interest rate sensitive, obviously, down 3.11%, making sense based on the Fed commentary. The XLV healthcare sector down 2.99%, just shy of 3 there. And the XLY consumer discretionary, a heavier weight risk on style sector, down 2.85% on the week. I wouldn't say that posture is overly concerning here. I mean, it would be one thing if the tech sector was down like 3, 4, 5% on the week, but it's simply not, as this breakdown sort of rebounded into that Friday session. Let's take a look at the structural charts, though, and evaluate what's happening. The XLE energy sector, I mean, there's nothing more to say other than the weekly breakout of the bull flag here. It's got to be inflationary, but it is upward pressure for the S&Ps as a whole. And if we just drop it back down to a daily time frame chart, this thing's really starting to ramp and get a little bit extended here. I wouldn't try to short the XLE, but this is definitely more bullish than bearish. Could it use a pullback? Yes. Can it catch a higher low? The answer is absolutely yes. On the monthly time frame chart, as long as we're over 94.25, the breakout is in force. Let's move along to communications. What's going on over here? Great move out of this as a balance range, forming a new balance range up here. The Thursday breakdown was not the end of the world. I mean, it didn't really print a new lower low on the week. Friday obviously rebounded straight back higher, thanks, of course, to Mark Zuckerberg's Fantasyland, which we'll get into. But as long as we can stay over 82.15, I mean, this is just constructive uptrend. This is just grinding in the upward direction. That is bullish for your S&P 500. I would really only become concerned out of communications if we get a larger break back down underneath 80 at this point in time. Real estate flipping to the bottom end of the barrel, rate sensitive. It is stuck inside the midpoint of this chop and slop zone. As we know with lightweight sectors, real estate is like the second lightest weight sector in the S&Ps. I would really only become concerned when and if we break down through a swing low. We're just not there yet. We're chopping around in the midpoint of a range. So moving on. XLV, second heaviest weighted sector by market cap. So right to the opposite end of the spectrum, right? Certainly an offering of a weekly lower high. The main concern here is any rejections underneath 144.80. If we stuff off of that on a reversal, that would start to become more concerning, and I would probably look for the S&Ps to continue to consolidate sideways, even if your NASDAQ and the XLK, the tech component of the S&Ps, pick up some of the slack. If you're just getting weakness out of the XLV, it's probably going to cause some pain, some push and pull in the S&P. So watching that very closely. As of right now, this is a red flag for your market. So I know it's been a long time before we've said, hey, red flags are going off, but this is what we're talking about in the intro, right? It's been in a nice bullish uptrend for quite some time. That uptrend is in jeopardy now, breaking down from the balance. Watching that lower high like a hawk at 144.80, or any consolidation down here is also not going to be helpful for the S&P 500. So here we go. Getting into the nuance, right? XLY, we were looking pretty constructive ahead of the gap down. Tesla delivery numbers on Tuesday last week, looking good on the gap up from Thursday, getting back towards that inflection point. Obviously, you can see where we've closed. So again, when we're thinking about red flags for the market, this dials back our bullish expectations. If this is a double top, if this is where we break down a big move, I would probably give some leeway and say that this might be choppy, but certainly underneath 176.50, I think you've got to acknowledge that this is not helpful for the S&Ps. It's certainly going to be acting as bearish pressure, and it's a heavier weight risk on style sector. So worried about this lower high, the bearish inverted hammer rejecting that level on the Friday session. The 50 SMA looks like a red flag, certainly looks like a red flag. Here's the XLP, consumer staples. This is a lighter weight D for defensive sector, so it's not as much of a red flag, but as we described, I mean, this is broken down through the support trend line. The clear up channel and just trend that it's been on for quite some time is changing tone. It is lightweight, it is D for defensive, so if any of the sectors are really going to see a material pullback and breakdown, it'd be great if it was the XLP, but as we just covered in the XLV, XLY, we've got red flags sort of emerging across the board. So lower highs here underneath 75 keep us bearish, looking for continued rotations in the downward direction. Moving along to the XLF financials. What do we see over here? Still okay out of financials, third heaviest weighted sector in terms of the S&Ps, and it is more risk on. The one thing that I like about this is the inside bar on Friday, not breaking down through the quote neckline of what could turn into a head and shoulders. So I don't want to hold my breath around 41.20, but if we can at least consolidate in the range, I would be thinking about much more of of bull flag consolidation instead of head and shoulders. So show me continued consolidation will be all right. Breaks higher lows over 42 are bullish. That's new all-time highs. If we break underneath, not looking so great, has to fall into the red flag category. SMH, semiconductors, I thought that there was going to be a nice reversal after multiple holds of the gap close level, as well as on Wednesday when we checked in on the close over the hammer high. Great gap up on Thursday, but we all know what took place, and now what's going on here, it's a bearish 3-bar play rejecting the bottom of the original range. You can see the upper wick on Friday underneath 224.75. So again, as we start to consider possible red flags for this market, the rotation here out of semiconductors, not the end of the world on something like a weekly time frame chart, but certainly bearish pressure intra-week as and if we need to attempt and retest 212 in the daily 50 SMA. Next up, we've got the XLK. What's going on with the tech sector? Obviously very similar to our QQQ NASDAQ, midpoint of the range. I'm not going to say it again. You know what not to do in there. If we're consolidating underneath 208, the threat, of course, is the NVIDIA earnings gap closing. Underneath 203.90 closes at 199.25. Seems to me like a little bit more of a red flag compared to being fine and dandy with breaks, higher highs, higher low pullbacks being offered. None of that is the case right now out of the tech sector. Next up, utilities. What do we see out of utilities? In terms of relative performance, I mean, it's not like it was green last week, but look at the structure here. Of all the charts that look fine, I mean, a great offering of a higher low on that Friday session. It looked underneath Thursday's low, closed back in the midpoint of the bull flag consolidation. This looks great for continuation. Unfortunately, it's a really lightweight sector for the S&Ps. It's also D for defensive, so not great in the grand scheme of things if it's going to try to lead your S&Ps to new all-time highs, which I doubt it would in the first place. But not a red flag, but unfortunately not a heavyweight meaningful sector. Next up, XLB. Same concept over here. Although not D for defensive, it is the lightest weight sector in the S&P. So this consolidation, although constructive for a huge bull flag on something like the weekly, it's not going to be enough to make or break, notably make the S&P 500 rally towards those all-time highs. Lastly, for our sectors is the XLI. This is a little bit more meaningful. This is 8% of the S&P 500 in terms of sector weighting. And you can see the structure looks great with all of these equal highs. A breakthrough of 126 would be fantastic. If we could do something like this, if the XLV can at least rally for a reattempt to the bottom end of the range, it's going to prevent an early week breakdown. If this is sort of consolidating, if the XLV is breaking down or just, not even getting that retest of the level, and the XLK is threatening the NVIDIA earnings gap, I think the writing's on the wall and you probably get a deeper pullback out of the S&Ps. But let's move on over to the ratio grid. Here it is. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I would argue that we have neutrality from a risk-on versus risk-off perspective. This is my largest concern. It's the downtrend out of the XLK relative to the S&Ps and the now clearly downward sloping 50 SMA. We were trying to hang on to hope with a neutral 50 SMA in here. Now we're just clearly lower. This is okay, and it's pulling some of its weight. We talked about the XLF near its all-time highs. This is absolutely atrocious out of the XLY consumer discretionary. This is trying to help, but neither of those two are nearly as heavyweight as what we have in the top quadrant. In the lower quadrant, I'm not overly concerned. This, of course, is very inflationary, but utilities are actually not continuing to outperform in a massive way. If the utilities chart here looked like the energy chart, I would say, yeah, it's time to run for the hills, but simply do not have that at this point in time. Diving into some specialized ratios, though, starts to reveal some more cracks in the armor. Look at the threat underneath the 50 SMA. We didn't really get acceptance below. This is the XLK versus the SHY, 1 to 3 year treasuries. So this is basically like as risk on as it gets versus as risk off as it gets. And as of right now, it's very, very mild, right? Very, very mild, starting to show some cracks in the armor. Here's the XLK XLU. This is where we have even more cracks in the armor, right? XLK risk on, XLU risk off. Breaking down, clearly getting acceptance underneath that 3.21. Don't worry about the actual number. It's the structure that counts, right? So drifting into a downtrend here is a bit more risk off, and we want to dial back some of those bullish comments from the SPY hourly chart, right? Here's the XLY over the XLP. It's stuck sideways in the range. This would be more bullish if it could break out. As of right now, probably sides with more neutrality. Here we go with the SMH XLV. What do we see out of semis and healthcare? Still holding up more so on the bullish sides of things, and that is mainly due to the gap down over on the XLV, even as the SMH kind of trickles in the the downward direction. So as long as this holds up over 1.49, 1.5 over the 50 SMA, trying to again align with neutral outcomes here, being open to either way, but you can start to see how momentum is clearly slowing down. It's not like we have these beautiful trend continuations underway as of right now. Let's move on over to the dollar. The dollar is also a bit perplexing here, especially noting what gold is doing and interest rates are also doing, but the attempt to continue a higher low over 103.75 is bullish for the dollar here, and if we can hold it, of course, in theory, breaking through these highs would put further downward pressure on equities, so watching out for that this week, but I would sort of keep an open mind to neutrality through here. It doesn't look like the dollar is trying to go anywhere anytime fast. If we just take a look at the range, I mean, we've been trading in this now for almost all year. Let's move on over to gold now. Gold completely breaking in the upward direction, and this to me is like, huge issue for the market. As gold is ripping this way, it's got to be somewhat indicative of like inflation, or at least the market having concerns about inflation really coming back with a vengeance. So I think, the Fed henchmen have done the right thing this week by coming out and sort of saying, hey, maybe cuts are not on the table, and certainly trying to dial back the market's expectation that quantitative easing is going to be here, easier financial policies are going to be here on the corner. Now, I get it. That's not really helpful for the IWM thesis that we've outlined so far today, but let's think about the sustainability of the market, right? We want the market to do the right things at the right times for the right reasons, and we certainly just don't want to jump the gun and just start pumping the market because, hey, it's fun when markets go up, right? We want it to be due to actual and true growth. So anyways, that's gold, a little bit of a rant there on gold. And obviously, so we haven't checked in on silver. Let's do that real quick here. Let's go /SI for silver. Silver is mirroring gold, right? It is seeing the substantial breakout. It's not, it's not the same magnitude as gold, but it's definitely playing along quite nicely. Let's move on over to the TNX interest rates. What's going on here in the 10-year? Continuing to break out on more of that Fed commentary, right? So the more time we spend over 4.33 is technically the interest rate, right? But 43.33 in the TNX, looking for that drift in the upward direction. Here is your pie in the sky inverted head and shoulders. You could call it an ascending triangle. You could call this thing whatever you want to call it, but the breakout is noteworthy here. And in theory, this should put a little bit of downward pressure on the QQQ, especially like those really rate sensitive tech sectors, which are fairly reliant on borrowing money, right? Especially, QQQ as well as the IWM. I think that the S&Ps get a little bit more cushion because they're a more blended and diverse basket of stocks, of course. Let's take a look now at, let's go on over to the inverted ZT to check in on what we're expecting out of the tracker tool, and it's continuing to drift in the upward direction. We've been, or at least maybe I should say I've been, I should own my own views and maybe not those of the chat here, but I've been fairly clear that I do not believe a June rate cut should be on the table. And I think the market's starting to price that in. So let's go on over and take a look. So there we have it. My wish is Jerome Powell's command, back towards 50-50 odds on the split for the June meeting between a cut and a pause. I would prefer to see this 2.4 jump on over to the pause odds as well, but I'll take it one step at a time. And of course, what really sent the market over the edge here in terms of probabilities was the Friday labor market report. Here you can see the actual reported numbers. The unemployment rate actually declined from 3.9 as the expectation and prior to 3.8, and nobody should be surprised about that because of our weekly check-ins on the initial unemployment claims, right? They're really not even close to 250,000, where we start to have some concerns about things spiraling out of control. The NFP, perhaps the biggest blowout number here, 303,000 versus 212,000 as the expectation. But Matt, what about the revisions? Relax, revisions happen to every single report as more accurate data comes out. Sometimes the revisions are in the downward direction, sometimes the revisions are in the upward direction. We'll take it at face value, but for right now, this of course is a good looking number. Let's take a look at the actual breakdown of where the jobs were added. You can see the government on top here adding quite a few jobs, but the biggest takeaway is that these slivers down here are really constructive, flipping back in the positive direction. Those slivers represent financial activities, a high paying job, right? That represents information going flat instead of actually decreasing, another high paying job, right? Manufacturing as well, the little purple sliver down here going positive, or at least flat, as you can see the zero over there, is a move in the right direction in terms of output, right? So this is a pretty constructive labor market report, and I wouldn't really look at that as being like overly cynical. One of the things that we need to be prepared for this upcoming week's worth of trade is, of course, the inflation report. So speaking of the dual mandate, I really believe Jerome Powell is going to have to acknowledge that price stability is more of a risk right now compared to maximum employment. I mean, the last, like Friday's report, blowout blowout numbers, things are looking great. I would imagine that multiple of the Fed henchmen start to acknowledge that as well in the speeches this week. So CPI on Wednesday at 8:30. We'll be live up in the Penthouse Suites. Coffee and donuts on me if you want to come out to the show. Again, here on the channel, 8:15 Eastern time, we will be live. You're also going to get the 10-year bond on the Wednesday session, FOMC meeting minutes. Not really expecting much of a reaction off of that. The market should already know what's in those minutes unless there's been an adjustment. PPI follows it up on Thursday at 8:30. No coffee, or excuse me, maybe no donuts, but certainly coffee on me up in the Penthouse Suites. We've got the 30-year bond coming out on Thursday at the 1 p.m. time frame. 1:01. And then on Friday, we get the consumer sentiment and inflation expectations for the month of preliminary reads from the good old University of Michigan. Be on the lookout for that. The other thing happening on Friday is that earnings season is here. We're going to kick things off, as always, with the financial companies, and JP Morgan Chase, the heaviest hitter in the XLF, reports first Friday before the open. Then we get Wells Fargo, BlackRock, Citi, and we'll move into some of the other heavier hitting banks as we approach the following week's worth of trade. But this should be on your radar. Earnings season is upon us. So moving on over to the risk appetite charts, you can clearly see the TLT ratio to the S&P drifted right back in the downward direction there on Friday. If we zoom in a little bit further, there were some concerns on Thursday as bonds caught a bid and the market absolutely sold off. But this is really not being reflected as a sustained concern that, there are internal issues here with our own economy. And we'll get into, of course, the reasoning in just a second. But if we look at bonds in relationship to themselves, no surprises over here, ticking higher on the Friday session in terms of duration, right? That's what we're measuring here. It's not surprising with the idea that the Fed is going to be higher for longer that these things moved in the upward direction. If there was a huge breakout on volatility and momentum, that would be much more concerning. It simply did not take place. So if that's not an issue, if credit spreads are not an issue, if we take a look at credit spreads, no issue here, certainly just sitting flat towards those 50 SMAs. Credit event doesn't seem likely. Let's take a look at the HYG. Junk bonds actually didn't even break down underneath 76.60 on the Thursday drawdown, right? Certainly don't get it twisted. I mean, there's a huge offering of a lower high. Doesn't look good, but we didn't break down there. This, of course, just ties back to directly the cause of what happened in the market here, right? And we all know this. We talked about it on the Thursday emergency meeting. If we jump on over to crude, CL, ripping in the upward direction, right? Let's go down to a 15-minute time frame chart. This is when the market obviously fell off of a cliff, and it's geopolitical tensions, right? So I'm not going to sit here and speculate about what happens over the weekend. That's not my job, nor am I interested in doing that. But if crude breaks down underneath this shelf and unwinds the move, I think it's the market literally showing you and pricing in that, hey, things have cooled off just a little bit. So instead of watching the headlines, just watch the price of crude oil, and I think that'll be a fairly large tell. You could watch 86. 86 to me is the level of interest. Previous resistance acted as support. If we drop it, that's where I think things cool off a little bit and the market, lets out this big sigh of relief. Let's move along, though, to Bitcoin in terms of continuing risk appetite charts, and you can see that we're building out this bull flag up here. If it breaks out, great, looking for follow through into new all-time highs. That, of course, is a risk on indication. Let's take a look at market breadth. Market breadth is somewhat perplexing. If you take a look at what happens on the 1 day, and I think I figured it out. I was probably too optimistic on the Thursday session there, but I was like, oh my goodness, market breadth in terms of new highs versus lows made a new higher high on Thursday as we were breaking down. It's obviously because of the morning gap up. So duh, Matt, that one should have been a little bit more obvious to me. And we did rotate lower to close out the week. So it's not looking awesome. We do want to stay over the zero line here in the grand scheme of things. If we're over zero, we're okay. If we drop the zero line, it starts to show more cracks in the armor. So we're keeping a very close eye on that this week with the move lower into the end of last week. Let's take a look at the SPX A200R well over the 50% mark. All good there. Same comment over here in the SPX A50R turning higher into Friday and certainly offering a weekly higher low. So we're good to go on this front. Let's move on over to the RSP equal weight S&P 500, getting a retest of the neckline of the head and shoulders. So I would say if you're looking for market breadth to improve, get us over 166.25, sustained bullish posture here in the S&P weighted. If you continuously reject this neckline and start to drift towards, I would say 158.50 is probably looking for a stronger pullback in the S&P. So this is do or die. We've closed right on the level, right? I would be inclined to say that with this breakdown, with it setting up as a bearish 3-bar play, I would look for a rejection off of 166.25, especially if rates continue in the upward direction, especially if small caps continue to break down, right? That would be at least worth a watch. But closing right on the level, I think, again, it sort of aligns with the neutral take we've had so far on the market needing to resolve that 517.25 in the S&P 500. QQQE undercut these lows, unlike what we have over here in the weighted. As long as we can stay over 87.10, I'd be open-minded to continuing to consolidate in the range in the weighted. If we continue to break down here, that's more of an issue. The fact that the sellers did not accelerate below would sort of give me some relief that maybe it is neutral in the NASDAQ. We'll finish it up with the Dow Transports versus Industrials, staying sideways in the range, not breaking down underneath the big important low level at 15.7. So, we did get a stronger pullback, obviously, out of the Dow, but transports aren't really yielding. Now, of course, they're massively divergent. And, in theory, if you want to play devil's advocate, you could look for something all the way like this and be okay out of transports to continue sideways. We don't want to take it to that point, but you get the idea. So the best thing that could happen for the market is that transports actually break out and cause this to act as a monthly or weekly higher low. If transports can crack 16,150, probably more bullish for the S&Ps and just the broad market as a whole when we're evaluating these things. Let's move along to the VIX volatility. What's going on here? This is where we have to start saying, okay, we've sort of dialed back to maybe being a little bit less bullish to, okay, maybe there are some bearish takeaways with the weakness out of the Russell, to then being like, okay, maybe there are some data points that suggest, no, maybe neutral is the right course of action based on credit spreads and sort of what we were just exploring in terms of risk appetite. But look at the VIX. The VIX is staying over 15. And I believe that, again, crude could be the big tell here. If crude pulls back more aggressively, it's probably looking like the VIX is going to come underneath 15. Geopolitical tensions get resolved, fine. Everything's fine and dandy. If we get consolidation over 15 and we start to rip this in the upward direction, everybody knows that higher volatility is typically not associated with bull markets, right? So I think we should be watching 15 very closely here. And as a precursor, we can watch out for the VVIX. The VVIX is higher for a bullish 3-bar play. It rebounded off of our complacency zone quite nicely, but it's not over the 103 handle. It's in this zone where typically the market has faded off of. So as your precursor, to give you the heads up on the VIX, and again, you could watch the CL as well, but if the VVIX fades off of this early on in the week, if you notice that the VVIX on Tuesday is trading 80s, 81s, 82s, then we're all good. And I think that the market probably remains neutral to bullish. If the VVIX remains elevated, 90, 91, 95, getting closer to 100, put your big boy pants on. That's where things get a little bit more interesting in the S&Ps. Let's move along to the VIX futures. You can see we're working towards a backwardation, but still in contango underneath the zero line. The one-day VIX as well remained elevated here. If we do something that looks like this, it's exactly where we've closed. If you want to look at, again, you could use the VIX, you could use the VVIX, you could use crude. If one-day VIX drops back down towards this floor at 7.5, a little bit more comfortable. Let's watch where the open happens on Monday for the one-day VIX to be a larger tell. The last thing I'll leave you with is a look at skew. And skew actually moved in the downward direction last week. Why is that? Because I think that people got, of course, what they were looking for on Thursday with a large drawdown, and then on Friday, when we actually rebounded back in the upward direction, people said, you know what, it's not worth putting something on in terms of far out of the money puts, pumping up that IV, skewing quite literally the options chain, and this moved in the downward direction. So people looking for a large crash didn't get that follow through they were looking for on the Friday session, and the skew is indicative of that. So if you get a lack of participants actually looking for that follow through move, if nobody's loading up on puts, if nobody's actually shorting the market, what does that mean? I mean, to me, it would just sort of suggest that the upward grind can continue. So that's been an in-depth look at the data points. Let's move into our core list. If you've made it to this point in the show, I'm sure you're enjoying the analysis. Make sure you're subscribed to the channel. Again, we're trying to hit 100K by May. This is a serious endeavor. Let's kick off the core list of companies, though, on a serious note with Apple and see what's going on here in terms of price action. Huge flush point building out at 109. This is almost a rinse and repeat on a smaller magnitude of what we had up here at 180.25, right? You can clearly see highs, lower highs, lower highs. Here you have highs, and lower highs. If we can crack the flush point, we're underneath 169, looking at 167, and further than that is 162.75. Let's drop it on down to an hourly time frame chart just to get even more granular. Take a look at the failure from the buyers into the afternoon of Friday. In theory, we open up underneath. There's this little consolidation. We're doing the dance underneath the multi-day balance range. So when we poke back into it, if the buyers are going to produce a look below and fail, you wanted to see a higher low over 169.80, rotate to the top of the range. 172 was the target. You can clearly see we've closed underneath. That is a failure from the buyers, and therefore I would be more inclined for short shorts out of Apple as long as we're underneath 169.80. If we're doing the dance in here, fine, we'll take it at face value. You probably want to see a higher low over the Friday high of day. Maybe you take it to the top of the range, but remain skeptical given the weakness on the daily time frame chart. Let's move on over to Microsoft. What's happening in Softy? Building out a balance range and honestly giving us a decent hold as of right now at 419.25. You can see the breakdown on the Thursday session at the low of day through that level. And then on Friday, let's go on down to the hourly now that we understand the context here. Let's go down to the hourly and you can see that there's an opening drive to the downside. That's the lower wick in the first hourly bar. And then we print a higher low over the multi-day highs, this inflection point at 423. On Friday, I was looking for the lower high underneath 423. So to see the higher low above, changing tone, holding that daily support here at 419.25 has to make me think that if this is a bull flag, if this is a pie in the sky, inverted head and shoulders, a breakout over 426.75 targets the all-time high. This is the improper end of the auction. This is not an excess high. It's basically a poor high. We don't have the market profile for Microsoft, but that would be a poor high. 430.25 when and if tested should break, and then we'll sort of determine next steps depending on the reaction to the break there. But the main point out of Microsoft is that consolidation over 423 after this failed breakdown from the sellers looks great for bullish trades over 426.75. Next up, GOOGL. Let's go on out to a daily time frame chart just to understand where we're at. This, of course, is your ascending triangle. Big break, failure back down, and now back higher. So again, this buy up on the sort of Friday session is really interesting because on the QQQ index, it actually looks weak with the closure underneath 441.50. But if you look at a majority of the components here, they actually retested and held key zones, right? We just saw that out of Microsoft. Now, Apple, of course, is the outlier, and that's a really heavy-weighted component, but you get the idea, right? So this is interesting to me out of Google, the fact that, we didn't really reject underneath 151.25, keeping us underneath this breakdown point. So to me, the next watch here is how we resolve this zone, and I think it speaks for itself, right? The daily breakout point versus the possibility of a lower high up against 1, 2, 3 equal lows. If we get the lower high and all of this remains as overhead supply, I would tend to think that it's not going to be an issue falling back down underneath 151.25. If early on in the week we start getting acceptance here, like we're talking about 5-minute opening drive, bull flag over 153.15, trading back into this breakout, which as we know is an all-time high, 155.50. Next up, we've got Amazon. Let's go out to a daily chart. We've been checking in on dailies today, so let's keep that theme. You can see that we're continuing the drift. We are continuing the drift in the upward direction. Really, really sloppy break of this area. It's been a grind in the upward direction drift as we're referring to it. So Thursday, it broke down underneath that key breakout point at 181. This is really what unlocked the move there on the Wednesday session. So to fail underneath it, close week at 180, it's totally just choppy in terms of actual participation. What we have into the Friday session is clearly a hold of the two equal highs. We are not getting any sell side acceptance back towards this point at 180. So I think it's, game on for where's the higher low. Show me the actionable setup on a 5-minute chart, and then we'll start to trade those scalps in the upward direction. If you're more of a swing approach trader, I would just say any higher lows over 182.80, right? You're good to go. Why wouldn't you be? You're looking at a consecutive set of highs, higher highs, lows, higher lows, higher lows, higher lows. It's all on the table. You're getting that grind in the upward direction. All-time high, 188.65. Next up, NVIDIA. What's going on with the one stock to rule them all? Looking a little bit weak compared to some of the other things we've checked in on. You can clearly see on Friday the offering of a move back over 871.50. That's the bottom end of the range here. Tradable outcome, yes, into the afternoon. However, I'd be thinking about the lower high opportunity here as the early week trade. So lower high underneath 894.50 sets up continuation of the downtrend here, and an equal high on the daily time frame chart. So let's do that. Let's stay consistent, right? Equal high, daily double top really gets aggressive underneath those lows. We're talking about a weekly pullback into this breakout point, 802.85. Anything beyond that, we're going to start thinking about 750. I don't want to be doom and gloom in NVIDIA, but you've got to at least acknowledge that this is no longer an AI mania. This was the AI mania. This was the gamma squeeze. This was an, oh my goodness, the stock's going to the moon. This is, let's cool it off a little bit here. We're clearly not getting that same level of participation and euphoria, and I think you got to be real with yourself and acknowledge that. Let's move along to AMD. What's going on with AMDizzle? finding a more permanent home on the watch list here. Breaking down from the balance range. So a bearish start here with a clear offering of a lower high at 172. I'd be thinking about shorts early on this week. As long as we're underneath this balance on a lower high, we've closed the gap, but the equal low is the target again at 164.60. If we're going to change tone, show me the higher low above. And, I would really be more neutral through here. The better breakout is going to be the longer the base, the higher the space, right? So that's going to be over 183.25. We're just not there yet. So I'd be patient on longs. Dial it back on longs. Let's go to the metaverse. What's going on with the daily time frame chart? What do we see over here? Double bottom, pie in the sky, but yes, double bottom, breaking out new all-time highs. It's the one name to rule them. Instead of NVIDIA being the one stock to rule them all, let's talk about Mark Zuckerberg and the fantasy land here. I mean, I certainly wouldn't want to participate in the metaverse, but in terms of the stock, glad to be a long-term holder of Meta. I mean, look at this thing. It's ripping in the upward direction. The breakdown on Thursday was not even a surface wound, right? It was a huge gap up. It didn't even close the gap. Never mind get acceptance inside of the Wednesday range. So bull flag consolidation looking for upside over 528.75, all-time highs. If we slip underneath 524, you guys know the name of the game. This is the Stevie Wonder trade on the open. So if we open inside or if we open underneath, looking for a short through the thin structure. Don't overstay your welcome. Higher lows can be found, should be found over the neckline of the pie in the sky double bottom. Key support on the daily is the top of the gap here at 510.75. Next up, we've got Tesla. What's going on with Mr. Musk? You can see, there's been a lot of noise about the robo-taxi, about the, M2, S2, whatever 2 car that, there was a fake headline about it being canceled, and just nobody knows what's going on with Tesla anymore. In terms of investor relations, I think Elon Musk is I don't know if he's the right guy for the job, but the stock price, let's talk about the stock. Let's not talk about fundamentals. It's just sitting in an H pattern. Here's your H pattern. Here is, if we go to the hourly, your failed inverted head and shoulders, left, head, right, didn't build out. Obviously, you're sitting on those equal lows. Large drawdown, on the Friday session, tried to rebound and just, got stuffed again. So not getting any love out of Tesla here. Again, it's been difficult to trade on the long side for a while now. I would try to align with shorts, but the chart does not look clear to me. I would suppose that the lower high and consolidation in here sets up continued breakdowns, equal lows one step at a time. Just watch for it to drive lower. But I don't, this seems like a failed move from the sellers to me. So I'm a little bit concerned about that. This failure underneath, higher low maybe into the afternoon. I'd be neutral through this range. This is a trade. You can probably hear it in my voice. Just very, very cautious of Tesla here. Not a very clear chart to be looking at, I don't think, with the failure, but just being in a very notable daily downtrend, weakness out of the chart. It's not so clear. So for that reason, we're moving along to Netflix, and then we'll get you those 4 trade ideas, and you'll be on your way. What do we see out of Netflix? It's the heartbreaker. It's down, it's up, it's down, it's straight back up. It's trying to make the move, I would imagine, into the weekly level at 644.75. How do we actually trade it? There might be something to do here early on in the week if it wants to cooperate. So here's the caveat, right? Netflix has to cooperate in the best sense there ever was. If there is any sort of indication of a breakdown underneath this level, you've got to be comfortable with this thing breaking down and then snapping right back in the upward direction, right? You've got to be comfortable with that mentally. If you can't handle that, if you can't handle a trade stopping you out and then working in the original idea, Netflix is not the chart for you. I'm just going to say that, outright right now. So manage your risk by using a tight stop. But if we can consolidate, a break of these equal highs could be on the table. Let's get you the number here. That's going to be at 636.50. If you could take out 636.50, looking for 644.75, but you've got to respect the stop underneath this consolidation. We know what can take place here. Look at the fake move. Look at the fake move. Look at the fake move. Look at this, right? So I would not want to get caught up in that. So know yourself psychologically, but those are the levels. If we're underneath 633.50, I wouldn't even try to short that. I wouldn't try to get on the short side of Netflix until we're underneath 623. Show me a stronger downtrend before we just get whipsawed back and forth and chopped out of a million positions. So that's the core list. Let's move into the 4 trade ideas. Oracle is up first on the chopping block. What do we see here in terms of the pattern? It's very straightforward as a head and shoulders formation, and if we can crack the neckline at 123.80, we're looking for the earnings gap to close. Now, the idea is not to go here in one trading session, but there should be an easier time moving in the downward direction. You'll also notice on the daily time frame chart a bearish 3-bar play set up as of the Friday close. Here it is on the hourly time frame chart. As long as lower highs are sustained underneath 126.30, I think we're good to go for bearish bearish consolidation, breaks lower highs, looking to take that short underneath that 123.80. Next up, as an idea, we have DDOG, Datadog. Let's move on over to the daily time frame chart, and let's acknowledge that this is a balance range. On the Thursday session, there was hardly any damage done. I mean, sure, it was an inverted hammer, but it's completely just a wall-to-wall move in the balance range. Same thing on Friday, but with a green bullish bar. So going back to the title of today's session, is the Thursday move an overblown reaction? If it is, I could certainly see Datadog breaking out in the upward direction over 125.30, tagging up to this flush point at 129.15. The daily 50 SMA is tangled up in there, but here we go on the hourly time frame chart. Be mindful. I would certainly be mindful. You've got this open, right? You've got this upper wick. This is going to be at 126.50s. So perhaps this is a scalp intraday, and then if you're a swing trader, you would start to acknowledge that and maybe be a little bit more in the clear up and over that 126.50. So that's the idea. Can we break this balance range, and can we get a range double, which would take us over this conservative target, which was structurally relevant at 129.15? That's Datadog in the upward direction. Not interested if it just fades and sort of drifts lower. Let's move along to the next idea, CELH, Celsius Holdings, of course. So never had one of the energy drinks myself, actually, but I hear they're pretty good. Anyways, here is the daily head and shoulders flush point underneath the neckline, looking for the lower high. So don't get too caught up in the idea that this is a huge uptrend. If this is a high, lower high, this can offer a lower high. We have lows and lower lows. Is this technically a nuanced downtrend? The answer is yes, in the very short term. Of course, you could say like monthly high or low, weekly high or low, that's fine. But if you can get a lower high, if there's clearly an asymmetric opportunity for a short opportunity here, stop above, retracement through the thin structure, I mean, think about the risk reward. Right, great opportunity there for a potential short on the back test of 86. Target would be the equal lows here at 76.75. If the market's really going to go to hell in a handbasket, if Thursday was just the beginning of something much more sinister, I could see this retracing some of the thin structure here. So again, not trying to be overly doom and gloom. Let's start one step at a time. Do we find a reversal pattern intraday at 86? That's your first step. Can we find sellers on the retest of 86? One step at a time there. Let's not even take it to the hourly. Next up, we've got KO. What's going on with Coca-Cola? Warren Buffett. How's he making out? I'm sure he's getting absolutely paid on that dividend still. So here we go. Look at the bar on Friday. Look at the area of support, 59. This is interesting because we had the follow-through move to the downside off the top end of the range, but at the bottom end of the range and the daily 200 SMA here in green, you can see we looked underneath the Thursday low, and then we closed where? Back inside of the Thursday range. So if there's going to be a long opportunity here, I mean, simply put, as a hammer candle, right, this could define your risk, long over the top, looking to target the top end of the range. That's like a 2-to-1. But as a day trader, right, as a scalper, this leaves a little bit to be desired. The y-axis here, the range it actually travels, is not the greatest. So let's be very clear about that first and foremost. But if we just take a look here, where can we find an intraday high or low over the top of Friday's high, which is going to be at 59.70, let's call it for round. Now, let's go 65. Can we go 65, 59.65 for round number's sake? Where's the high or low? Where can we participate in this as a day trade in the upward direction? That, to me, is the more interesting opportunity for a bounce off the bottom end of the daily balance range. That's all I've got for you in today's episode of the Weekly Watchlist. Don't forget that we will be live all of the days of the week, but on Wednesday, 8:15 is when we're live. 8:30 is the CPI Coffee and Donuts on me. Come hang out with us for the pre-market prep. If you learned something new today, let me know down below in the comment section or by giving the video a very simple thumbs up. Remember, 100K by May. And with that said, I wish you a green trading week.